the last time we looked at FRA and options on FRA, which is also called IRG. Still looking at how to manage interest rate risk. And remember what we said about it is the fact that we are exposed to interest rate risk when we have either loans that we pay interest, or we have an asset or a deposit investment that gives us income based on interest rate. And what does that mean? It means that whenever interest rate changes, we might lose or we might gain. But the part where we are so concerned is the fact that we might lose some money. And when we say we might lose some money, it's not that we cannot gain as well, but we rather manage the loss aspect. So for someone that has a borrowing or a loan, where it might lose money is when interest rate is going up. So that kind of person will want to fix the interest rate such that if it goes up, it's not affected. But for a guy that is thinking of avoiding to lose money because of his investment, he's rather worried about interest rate going down. So if he's trying to fix the amount of interest that he will be getting so that that will be his worst case scenario. And that is the bottom line of managing interest rate risk. Whatever strategy you are using, that is what you are trying to achieve. So we're going to look at a different strategy today, in fact, a couple of them. And I'm going to start with the futures, interest rate futures. And the basic thing which I always tell you about future is to always think about three transactions. The fact that you always have to initiate it, you have to close it, and you have to do the real transaction. The same thing is still applicable here. Very important. So, which means when you want to use futures to do interest rate hedging, you're going to either buy or sell the futures. You do the opposite to close it, and you will do the transaction. The result that you get from all of this, the net is your outcome. So, which means this will usually give you a PLL that either increases this or decreases this. But this is not exactly straightforward the way you were looking at FX futures. I need to give you like a clue on how to deal with this. Because you are not selling or you are not buying interest rates, but there's there's an instrument that generates interest rate, which is probably a loan or a bond. So the best way to be able to interpret your interest rate futures is to always look at it in form of a bond. So if you want to know what does it mean to buy futures, interest rate futures, or sell interest rate futures, think about it as a bond. If you look at a bond, when you are selling a bond, what are you doing? It means that you are borrowing. Whereas if you are buying a bond, it means that you are investing or you are lending. So this is like a deposit. So which means that if you are looking for a future to use, like I always tell you, your future must always go in the same direction of the transaction that you are trying to hedge. So which means if your transaction, so if you want to know your situation now, which should be your future. So if you are trying to borrow, so if you plan to borrow, in the future and you want to hedge and you want to use interest rate futures, what you are trying to say is that borrowing means selling of bond. So in that case, your future that you're going to be using must be selling future. So it means that you will be selling this future, and that is how you're going to hedge that kind of transaction, this situation that you find yourself. But if your situation is the fact that you plan to invest, and I've told you, if you plan to invest, your future as well that you are trying to use to hedge must reflect the same exposure that you have. So what you will initiate is to initiate buying futures. I hope this will help you. This is extremely important because this helps you to be able to interpret what we're going to be doing as we progress into the lectures. Remember two things. Number one, think about the situation in terms of selling bond, right? So which means your exposure is either you are borrowing or you are investing. Borrowing means you are selling bonds because selling bonds is you trying to borrow money from people and giving them paper to say, give me your money, I give you bond, I'll redeem later. But if you plan to invest, it means you're actually buying the bond. So if you want to hedge investment, then you need to buy future. And if you want to hedge borrowing, then you have to sell interest rate future. Remember, we're talking about interest rate future, RF. The next thing that we need to understand is how future is being priced, because this is different from what you are used to. Because in FX futures, you just see the rate the same way the FX rate is being quoted. They give you the similar rate or no. But for future, it's slightly different. It's not quoted in rates. It's quoted like a price. So please know that the price is quoted as 100 minus applicable interest rate. 100 minus applicable interest rate. So which means, for instance, if what you're trying to do is to fix rates at 5%, this particular feature will be quoted at 100 minus 5%, and you will see that the future price will be 95. Not 95%, please. It's just be quoted as 95. So which means whenever you see the future price quoted like that, you know that the rate is actually 95, 5%.
Sorry, is the 95 like a basis point?
No, because 95 basis points is 0.95%. So anytime you have basis points, that is divided by 100 to get percentage. So don't look at it as basis point, please. It's just a quote system for future. Does it make sense, Rotimi?
Yes. So the 95 is just a number without any units
Yes, is
or
the price.
yeah.
Yes, it's just a
Okay.
95. They just said 95. Once they say 95 is for you to understand that 95 means 100 minus 95, and that means the applicable interest rate for that loan or for that deposit is 5%. I also need to mention to you for sure, sometimes question can be very confusing. They might give you two types of future prices. They might say there is an open future price and there is a settlement future price. This one, I'm just mentioning it quickly. There's nothing to waste time on this. Opening, yes, beginning, settlement is the final one. Please, is the final one that you always have to use. Don't bother yourself. Anytime you see open future price, not your business. This is what we always use. It's always settlement future price that is relevant for what we are doing. So please take note of that. There's something I also mentioned to you that whenever you are using a traded instrument to do hedging, unfortunately, it's not in your control to determine what is available in the market. Market will have to determine that for you. And what does that mean? It means that you might need some quantity and that quantity might not be available in full because of the way market is quoted. And that takes me to you knowing how to calculate number of contracts because you must always work with number of contracts. The reason being that if you don't work with number of contracts, you might assume like you are able to hedge everything. And in reality, you might not be able to hedge all your exposure because of the volume or quantity of contract that is available or the unit of contract available in the market. So you must always know that you must work out your number of contract before you calculate whether it's cost or whether it's benefit or whatever you're trying to do because you might have a portion that is not edged, and that will not be part of your calculation for your edge strategy. When you're done with your edge strategy and the rate transactions, then you can see what that comes to and also consider what has not been edged. As we've seen in the previous example that we've actually done, I think under options that have been traded. So, but if you have IRF as your edge strategy, and you need to calculate how many contracts you will need. Please just note, it's very straightforward. The easy thing to think about is to say number of contract will just be the loan amount, or even you can say the investment amount divided by your contract size. Remember, sometimes they might say each contract is 20,000. And if your loan is 100,000, then you can easily say you need 5 contracts. But I'm going to give you one quickly now. You cannot use just this formula, and I will tell you why. Because what you are dealing with is interest edge. So, which means you must be able to mirror like for like. Very important. And what do I mean? Period. So, you cannot have, take for instance, a 6 month contract and you are edging 2 month contract. 2 month transaction. If you use it, the formula as it is, then the interest you're going to be getting here will be for 6 months, whereas you are trying to edge a 2 month transaction. So it's not like for like. You're not mirroring the period. You're not mirroring the tenor. So for you to be able to mirror the tenor, you must be able to adapt your contract size to the transaction, your contract period to your transaction period. So which means the best thing to do is to always divide the results by the contract duration so that you know that you have number of contract for one duration, and whatever the duration of your transaction is, then you can multiply by that. Just the same way you will say, oh, if you are trying to convert 3 months to years, you say, okay, first of all divide by 12, then multiply by 3. That is exactly similar thing that I'm saying here. So this you will need to multiply by the transaction, which is your loan or your deposit tenure. So loan or your deposit tenure. Please take note. Any question? Very important. And that's how you make your contract to reflect the tenor of the transaction that you're actually trying to hedge. And like we did for other future transactions, there's always a tick, which I've always told you is your minimum. Anytime you air tick, that's your minimum movement of that value of a future. Because usually what you stick for is to calculate profit. It makes life easy for you to calculate your profit or loss. Right. And tick is just an absolute value, but you might also need to know how to calculate tick value for this one. Because it's slightly different from FX, and for interest rates, it's quite much easier. Maybe just the fact that okay, you've not done any interest rate hedging before, like in FM, you at least been exposed to some kind of FX hedging. So this might sound a bit new, but by the time we start solving more questions and more questions, then you realize that it's actually pretty better than the FX one. So if you want to get your tick value, just easy. It's always 1 basis point. And you know what 1 basis point means? 1 basis point just means 1 divided by 100%. So that is 0.01%. That's what 1 basis point means. So 1 basis point multiplied by the fraction of the year. So the contract fraction of the year. So if the contract is for 6 months now, you're going to be using 0.5 for this. So don't confuse that with this. There are different things. This is talking about number of contracts. This is about the value of a tick. Yeah, then this multiplied by the value of the principal, which is your loan value, which will be given anyway for each contract in terms of the value of the contract. Yeah. So take for instance, if you are saying you are looking at a contract, say let's take for instance, say there's a contract value of, remember, interest rate edge will always have a principal loan, yeah. So of a $500,000, and let's say this is for 6 months. What would be the tick value for this? That's 1 basis point, which is 0.01%, multiplied by 500,000, multiplied by 6/12. If you use your calculator, what do you have? That gives you $25,
Fine.
right? So if you see the global goal, this guy wants to borrow, and he wants to borrow 9 million euro for just a month, and he plans to do it. So this is now in 5 weeks. He wants to borrow. This is transaction time, transaction date, when he will borrow, and he will borrow for just one for 1 month. So this is now. In 5 weeks' time, there's a transaction that is meant to happen, and that transaction is just for a month. So what we want to hedge is 1 month interest. So that's what we want to hedge. We want to hedge 1 month interest. The base rate is currently 3%. The Treasury of Global decides to fix the rate by selling interest rate futures at 96.9. What interest rate is that? If it's selling interest rate futures at 96.9, what rate is that? What rate is he trying to fix at?
3.1.
3.1.
3.3.
Fantastic, fantastic, nice. The market rate subsequently rises by 25 basis points to 3.25. As soon as the loan is agreed, the treasurer closes out the global's position by buying a matching number of contract at 96.65, which is what you would expect. You have to close it out. Yeah, the first one is how many contracts do we need to buy? I told you that number of contracts you have to buy is a function of the the total principal that you want to hedge, divided by the contract size. But you must always apportion it based on the reality of the transaction period, which is the transaction tenure, divided by the contract tenure. So in this case, the contract that is available is of what size? Did they give us?
1
They said,
million.
yeah, 3 month contract is for 1 million. So we have the contract size 1 million and it's for 3 months. As you can see, it's for 3 months. So which means that we are only interested in hedging 1 month interest, but the contract that we have will always be giving us 3 months. So we need whatever size we get here, we need to divide it by 3 to get our 1 month. And that's why if you apply this formula now, what you are trying to hedge is 9 million. The contract size is 1 million, then time divided by 3 and times 1. And that is why the contract size, the number of contracts that we need will be 3 contracts. If you had not done this, you would have bought 9 contracts, which would be too much for you. Now, do you understand what we were talking about now? When we do questions, you will get it. That is what I was trying to explain here. So, because the interest, if you buy 9 contracts, you'll be hedging 9 million for sure. However, by the time you multiply by the interest for 3 months, that interest will be 3 times the interest that you're actually trying to hedge. Good. Now, we should demonstrate that in this case, the gain on the futures will match the extra interest on the loan. First of all, what is the extra interest on the loan? Let's try and look at that. Because that is actually the risk, the problem. The interest rate has gone up by 25 basis points. And the loan is for 9 million. So 9 million, 25 basis point means 0.25%. And this is for 1 month. So divided by 12 times 1. So the extra interest, if we had not hedged, would have been how much? $1,875. It's confirmed. If you have something different, let me know. But that's what I got. So which means that if we did not hedge at all, we would have had to pay this total amount. But this is what we are trying to hedge. And let's see whether the hedge that we did truly helped us. Which means if there is an additional payment of this, because this is an increase in interest rate, so this is a loss. We would definitely expect that the hedge that we have done must be a gain that is of that amount. But let's find out whether that's the truth. So for each contract, what we know that each contract will give us how many value of tick. So each contract, let me break it down. Yeah, we move by 20, they said 25 basis points. That is the movement of interest rate. So that's 25 ticks. I will know that the value of each tick is what? We got it. Did we calculate it? If not, if we have not, can you quickly calculate value of tick for me? Okay, so let's look at it. Remember, we said the value of each tick is always going to be the principal, the contract principal, multiplied by 1 basis point, then multiplied by the contract tenor, but must be in years. The contract principal is 1 million, multiplied by the 1 basis point, and 1 basis point, I'm sure you know that is 0.01%.
But a quick
And
question.
go ahead, please.
In the question, it said it's 25 basis point.
That is how the interest rate movement. We are calculating value of
Oh,
tick now.
oh, I
So for value of tick, please note that this is fixed. This does not change for value of tick.
okay. Okay.
This is a fixed formula that you must always use. It's always 1 basis point. Multiply by your contract principal, multiply by the contract tenure in years. And if you do that, that will give you $25.
Sir, could you explain
25 euro.
why the contract principal is 1 million again?
Okay. It's stated. They told us that it's 1 million. Let me show you. Can you see this?
Yes, sir. Yes, sir.
Yeah. Yeah. 3 month contract for 1 million. Yeah. The contract, the value of the contract for one contract will always be given to you. Okay, so now we're fine. We know the value of one tick is $25, 25 euro. And we know that how many contracts do we need? 3 contracts. So which means the P or L straight away is equals to the 25 ticks because our interest has moved 25 times basis point, 25 basis point, times the value of each movement. That is 25 euro. Then we bought three. We bought 3 contracts. How much would that give us? See, that gives us a profit of 1875.